The financial media is lying to you, and it is costing you your financial freedom. Every time you open an app, turn on the television, or read a headline, you are being fed the exact same toxic narrative. Interest rates are at 7%. The housing market is crashing. It is the worst time in American history to buy real estate. Sit on the sidelines. Wait for rates to drop. Listen to me very carefully. The media produces content for the masses, and the masses are broke. If you want to build generational wealth in the United States, you must do the exact opposite of what the paralyzed middle class is doing. Amateurs let interest rates dictate their financial future. Professionals manipulate interest rates to build their empires. If you are sitting on your cash, waiting for the Federal Reserve to magically drop rates back to 3%, you do not have a patience problem. You have a strategy problem. You are fundamentally misunderstanding how the banking system works, and you are missing the greatest wealth transfer opportunity of this decade. Today, I'm going to give you the exact mathematical blueprint to weaponize today's high interest rates. I am going to show you how to buy a house right now, bypass the 7% rate entirely, and force the desperate seller to pay for your massive monthly discount. This is not a theory. This is the 2-1 Buydown strategy. This is property path. Stop watching the news. Let's get to work. To understand why this strategy works, you have to understand the psychology of the current American real estate market. You have to understand the blood in the water. Back in 2021, money was practically free. Anyone with a pulse could get a 3% mortgage. Buyers were waiving inspections, offering $50,000 over asking price, and begging sellers to choose them. Sellers had all the power. They were kings. Then inflation hit. Jerome Powell and the Federal Reserve slammed on the brakes. They hiked the federal funds rate faster than at any point in modern history. Mortgage rates doubled in a matter of months. Overnight, the retail buyers vanished. The people who were approved for a $500,000 house could suddenly only afford a $350,000 house. Their purchasing power evaporated. Now, look at the sellers. There are sellers right now who absolutely have to move. They are getting divorced. They are getting relocated to Texas or Florida for their corporate jobs. They inherited a property they cannot maintain. They put their house on the multiple listing service, the Milliliters, expecting a bidding war. Instead, they get crickets. Week 1 goes by. No offers. Week 2, price drop. Week 4, another price drop. By day 60, that seller is in a state of sheer panic. They are paying a mortgage on an empty house. They are paying property taxes. They are paying insurance. They are bleeding cash every single month. This is where you step in, but you do not step in like an amateur. An amateur looks at a house listed for $400,000 that has been sitting on Zillow for 60 days and says, the seller is desperate. I am going to offer them $360,000. The seller gets offended. Their ego is tied to that $400,000 number. They reject the offer or they counter at $390,000. You get nowhere. You are not an amateur. You are a transaction engineer. You understand that the purchase price is an illusion. The only thing that actually matters is your monthly cash flow. You tell your realtor to write a full price offer. You offer the seller exactly what they want, $400,000. You stroke their ego. But you include one absolutely non-negotiable contingency. You demand a massive seller concession. You write into the contract, buyer offers $400,000 purchase price, contingent upon seller providing a $10,000 credit to the buyer at closing. The seller looks at the offer. They are getting their full asking price, which means they get to save face with their neighbors. They just have to leave $10,000 on the closing table. Because they are bleeding cash and desperate to escape the mortgage, they signed the contract. You just legally extracted $10,000 from the seller's equity. Now, what do you do with that $10,000? You do not use it to buy new furniture. You do not use it to paint the living room. You take that money and you hand it directly to your mortgage lender to execute the 2-1 Buydown. Here is exactly how the math works. Pay close attention, because this is the math that separates the wealthy from the working class. Let's assume the current market interest rate on a standard 30-year fixed conventional loan is exactly 7%. When you purchase a 2-1 Buydown, you are buying down your interest rate for the first 2 years of the loan. In year 1, your interest rate is artificially reduced by 2 full percentage points. You are not paying 7%, you are paying 5%. In year 2, your interest rate is reduced by 1 percentage point. You are paying 6%. In year 3, your interest rate normalizes and returns to the base rate of 7% for the remainder of the loan. Let us look at the raw numbers on a $380,000 loan amount. At a 7% interest rate, your principal and interest payment is roughly $2,528 a month. That is the terrifying number keeping the middle class on the sidelines, but you are not paying that. In year 1, your rate is 5%. Your monthly payment drops to $2,040. You are saving $488 every single month. That is nearly $6,000 in pure cash flow savings in the first 12 months. In year 2, your rate is 6%. Your monthly payment is $2,278. You are saving $250 a month. That is another $3,000 in savings. Add it up. Over the first 24 months of owning this property, you have saved roughly $9,000 in mortgage payments. But here is the absolute genius of the American banking system. The bank is not giving you this discount out of the goodness of their hearts. The bank still wants their full 7% yield. So, who pays the difference? The seller pays the difference. That $10,000 seller concession you negotiated earlier, that money goes into a specialized escrow account held by your lender. Every single month for the first 2 years, the lender automatically pulls money from that escrow account to make up the difference between your discounted payment and the full 7% payment. You are using the seller's own equity to subsidize your lifestyle and protect your cash flow. You bought a house in a 7% environment, but you are living with a 5% payment. You completely bypass the system. But I know exactly what the cowards in the comments are typing right now. They are screaming, "What happens in year 3? What happens when the subsidy runs out and the rate jumps back to 7%? You are going to go bankrupt. You are going to lose the house." This is the exact trap that destroys the financially illiterate. This is the hurdle you must understand to survive. The strategy I am teaching you is not a subprime adjustable rate mortgage from 2008. This is not a predatory loan. The golden rule of the 2-1 buydown is the underwriting process. When your lender approves you for this loan, they do not qualify you based on the 5% promotional rate. By federal law, they must qualify your debt-to-income ratio based on the maximum 7% note rate. The bank will not legally give you the loan unless you can absolutely afford the 7% payment. Therefore, you must underwrite your own life. If you are buying this as a primary residence, you must be comfortable paying the 7% rate in year 3. If you are buying this as a rental property, your rental income must cover the 7% payment. The 2-1 buydown is not a life raft for people who cannot afford the house. It is a strategic cash flow injection for investors who want to maximize their leverage. So, what is the actual endgame? Why go through this entire process if the rate eventually goes back to 7%? Because you are dating the rate and marrying the house. The macroeconomics reality of the United States is that the Federal Reserve cannot keep interest rates at 7% forever. The national debt is too high. The cost of servicing the federal deficit is astronomical. Eventually, the economy will cool down, inflation will break, and the Fed will be forced to cut rates. Maybe it happens in 12 months. Maybe it happens in 24 months. But what happens the exact second that national average rates drop to 5 or 5.5%? You call your mortgage broker and you execute a standard rate and term refinance. You permanently lock in a new 30-year fixed mortgage at 5%. You never even see the 7th year of your original loan. You never make that 7% payment. And what happens to the money sitting in that escrow account? The seller's money that hasn't been used yet? It does not go back to the seller. It does not go to the bank. That money is legally yours. If you refinance in month 14, the remaining thousands of dollars in that escrow account are automatically applied as a principal reduction to your loan payoff. The seller literally paid down your debt for you. Now, let us zoom out and look at the brutal reality of the people who decided to wait. The amateur decided to sit in an apartment for 2 years, paying 100% interest on a lease, waiting for rates to drop to 5%. 2 years from now, rates finally hit 5%. The amateur is thrilled. They log on to Zillow, ready to buy. But what happens when rates drop? Millions of other paralyzed, terrified buyers flood back into the market all at once. Inventory vanishes. Bidding wars return. That $400,000 house you bought, The amateur now has to pay $460,000 for it, and they have to waive their inspection to get the contract accepted. They waited for a lower rate, but they paid $60,000 more for the exact same bricks and drywall. They lost the game. You bought the house for $400,000 when there was zero competition. You used the seller's money to artificially lower your payment to 5%. Anyway, you collected 2 years of loan paydown, you collected 2 years of tax write-offs, and then, when rates naturally dropped, you permanently refinanced. You secured the low purchase price and the low interest rate. You extracted maximum value from the American financial system. Stop letting the media dictate your wealth. The market does not care about your feelings, and it certainly does not care about your savings account. The market rewards people who understand leverage, math, and negotiation. If you have capital sitting in a bank account losing purchasing power to inflation, you are making a massive mistake. I want you to close this video. I want you to open up your local MLS or Zillow. Filter for properties that have been sitting on the market for more than 45 days. These are your targets. These are the bleeding sellers. Call your realtor. Tell them you want to submit a full price offer with a 3% seller concession to fund a 2-1 buydown. Stop waiting for permission to build wealth. The opportunity is right in front of you. Execute the strategy. I will see you at the closing table.